Welcome to Adjusting Entries, Accrued Revenue. By the end of this ACCT, you should be able to recognize accrued revenues and record applicable adjusting entries. In simple terms, an accrued revenue is where you earn first and receive cash later. Think about situations in which a business earns first and receives cash later. Common examples are providing services on account or earning interest. We'll use providing services on account as our accrued revenue adjusting entry example. Let's say that on February 4th, 2015, you, the accountant, received the yellow copy of a sales invoice showing that your company provided services on account to a client on January 29th, $400. You're lucky to be getting this on February 4th. Sometimes source documents straggle in even later, even with computers. If you had received the sales invoice in January, we would record it as a regular transaction. But because you are receiving the sales invoice in February for services provided or revenues earned in January, we will need to make an adjusting entry, using the exact same accounts as we would have used in the regular entry. This is another of those situations where timing causes us to need to make an adjusting entry. To create our adjusting entry, we need to know what accounts are affected. Service revenue, because we have earned, and the other account, accounts receivable, since we've earned but not received cash. For service revenue, what type of account is it? Revenue. Increase side for revenue, right? Which way did our revenues go? Up. So service revenue is on the right side of the entry. For accounts receivable, what type of account is it? Asset. Increase side for an asset is on the left. Which way did our right to receive go? Up. So accounts receivable is on the left side of the entry. In the adjusting entry section of our journal, we'll record the adjustment using the last day of the accounting period for the date. Next, we'll post to the ledger. Then we'll transfer the account balances to the trial balance. We'll do this as of January 31st. And we'll mark their account types. Accounts receivable gets an A for asset. Service revenue gets an R for revenue. Then the accounts and their balances move to the financial statements. The R goes to the income statement, and the A goes to the balance sheet. Thanks to our adjusting entry, our income statement shows the service revenue that we earned in January, and our balance sheet shows that as of January 31st, we have the right to receive $400. When we receive cash from our client, hopefully sometime in February, we will debit cash and decrease accounts receivable by putting it on the right side of our entry. The effect of our adjusting entry is that we followed the revenue recognition principle and recorded our revenue when we earned it in January, even though we received cash later. The shortcut for accrued revenue adjustments is the account on the left side of the entry will be an asset, for example, accounts receivable, interest receivable, fees receivable, or note receivable. The account on the right side of the entry will be a revenue, for example, service revenue, service fee income, or fees earned. This concludes the ACCT Adjusting Entries, Accrued Revenue.